Okay, recording is already in process and let's start. First of all, I would like to open the presentation of the first topic and to comment some issues and to discuss some basic moments. And after that, we continue with the current material. Oh yes, I will add people to the channel in just a moment. I was sure that already. Oh yeah. Okay. Well. So, dear students, first of all, some questions from the first topic, financial accounting and the format of financial statements. I will open slide or show. Once again, learning objectives to recognize the information in the 4 basic financial statements and to identify the role of accounting principles, accounting standards. So let me repeat once again the structure of accounting itself. Accounting, this is a system, and this system consists of 2 main components, financial accounting and managerial accounting. So financial accounting, this is the main language for communication with external decision makers, everybody outside the company. And also it could be people inside the company who don't have any access to the accounting information. For example, the most employees don't have any access to accounting information, and on one side it's internal employees inside the company. On the other side, they are external in the possibility to access the accounting information. And managerial accounting, this is accounting for about how to prepare detailed plans, how to evaluate performance, how to control costs. And this information definitely important for those who is responsible to run the business. And we call these users as internal decision makers. It's always managers, maybe the board of directors and other people who are involved in the management of the company. This part you will learn in the second module. And in this first part, we just concentrate our attention about financial statements, how to prepare financial statements, what information can we get, and how to interpret this information. Business activities can, well, in every subject you can find different classifications based on different criteria. As for accounting, this is a classification based on the nature of business activities. And normally we divide business activities into 3 main sections, into 3 main streams: operating activities, financing activities, and investing activities. And now 4 basic financial statements: balance sheet, income statement, statement of stockholders' equity, and statement of cash flows. When I finish with this brief explanation, I will show you the 4 videos about each statement in order to refresh the material and to continue. What is important in theory of accounting, of course, the main accounting equation, or in other words, we call this accounting equation as a financial position. What does it mean, the financial position? This is the economic resources which are available in the company. And of course, all resources always have sources. So this is why we say assets are always equal to liabilities and stockholders' equity. It means that for every resource, we can find source of financing. And these sources can be divided into two main components. Sources from creditors, and we call these sources as liabilities, obligations, something to pay back to the creditors. And the second component, stockholders' equity. Stockholders' equity, this is sources from stockholders. So this is what we call main accounting equation, or the financial position of the company. So this is the typical list of typical items in every component of the balance sheet. Assets, and in our course we learn in detail some of these items, not all of them, because we have the basic course. And also we just discuss liabilities and stockholders' equity in order to understand the main principles and rules to disclosure these items in financial statements. This is an example of the balance sheet. So we have 4 lines of heading: name of the entity, title of the statement, specific date, and unit or measure. And this is the typical example of the balance sheet: assets, liabilities, stockholders' equity. And the same with the income statement. Income statement provides information about revenues and expenses. In order to compute financial result, it could be 2 options, commonly 2 options, profit or loss. Of course, it could be the 0 case, no profit, no loss. But we just call for the profit, and we are looking for the profit. And this is what we call the main criteria of business existing to generate more benefits than some kind of sacrifices or some kind of sources outflows. So this is the list of revenues and expenses. So sales revenues, interest revenue, rent revenue, and this is expenses. Also in our course, we discuss these items and understand. So this is the format of the income statement. Statement of stockholders' equity. Statement of stockholders' equity disclose information about the main elements of the equity. Basically, stockholders' equity includes 2 main components: share capital or common stock, or it could be the title contributed capital. But this component, this is the contributions of the owners of the business to start the business, to have these component of the owner's funds in the business. And the second component, this is the retained earnings. Retained earnings, this is the retained and accumulated net income for several accounting periods. And finally, statement of cash flows. The basic goal of the statement of cash flows to disclose information about cash inflows and outflows from operating activities, investing activities, and financing activities. And what is important to mention that each of these 3 cash flows categories can be positive or negative. So it could be negative or positive cash, net cash flow from each activity. Well, and right now I would like to show you 3 main types of relationships between these financial statements. First of all, in order to prepare the package of financial statements, we should start with the income statement and calculate net income. In simple words, how to calculate net income? We should take revenues and subtract expenses. Revenues minus expenses, we get net income. The second step is to calculate retained earnings. This is why the second step, just to prepare statement of stockholders' equity. So we should take the beginning retained earnings. It means the retained earnings from the previous period. Then to add net income from the income statement as a financial result for the current period. and to subtract dividends if this item is available, and then get the ending retained earnings, ending balance of retained earnings. Finally, we can prepare balance sheet. We can prepare a balance sheet. Why on the third step? Because we already calculated ending retained earnings, and now we have this component in order to prepare balance sheet. And finally, the main relationship between balance sheet and statement of cash flows. When we prepare balance sheet, finally we calculate the net change in cash, but also we should disclose information about beginning cash flow and ending cash flow. And ending cash flow should be absolutely the same amount as cash on the balance sheet. I would like to mention here that, of course, in reality, we have much more relationships among financial statements, but right now for our basic course, it's important to understand these information flow in preparing financial statements. Notes. I hope now you understand, maybe in general, that financial statements provide very aggregated information. And it's really not enough to understand the content, the nature, and to evaluate the future of the business. This is why the notes are the integral part of these financial statements. What does it mean, notes? Notes, this is the all additional supplementary disclosures in order to understand the content of financial statements. So, dear students, I would like to recommend this slide as a good summary about all financial statements. You see, this is a good table with the title of the statement, the purpose of the statement, structure, and examples of content. So what I recommend you to make a photo or to put some on the place where you can see from time to time this slide. And of course, you see all these formulas are really very simple, but if you put this slide somewhere where you find it's more for your maybe memories, maybe a better understanding. Of course, it's a question. When we prepare financial statements, what rules we should follow? What is the requirements? What is the regulation for preparing financial statements? And we call such rules and principles, requirements, maybe some short statements as accounting reporting standards or accounting standards or reporting standards. It could be different titles, but of course we should distinguish between national accounting standards and international accounting standards. For example, in Russian Federation, we have national accounting standards. So these are the set of documents which are written in Russian, and these standards regulate accounting procedures in our country. But if we would like to operate on international global level and to participate in listing activities or to attract foreign investors, or of course to develop and to improve the accounting process, we can use these international financial reporting standards for preparing statements and also to organize the accounting process itself. So in our course, we will learn accounting based on international financial reporting standards. So this is the set of global accounting or financial reporting standards. There are two components, accounting standards and financial reporting standards. And I would like to say that in Russian Federation, all our national standards were developed based on international financial reporting standards. So you can find a lot of similarities in our Russian accounting system and in international financial reporting standards. For those students who are from other countries, of course, you can find that in your country, national standards could be maybe not absolutely 100%, but more than 90% similar for the International Financial Reporting Standards. And because of this situation, this is common and global standards, we have this course. Well, I think that maybe this is the end of basic ideas of the first topic. Right now, I would like to show you once again these short videos, and then we continue with the current material. So let me open. Okay, so first of all, I would like to start with the 4 basic financial statements, just to repeat in brief, and then we discuss each balance sheet, income statement, statement of stockholders' equity, and statement of cash flows.
To report information to investors, creditors, and other external decision makers, 4 financial statements are normally prepared by a profit-making organization. The balance sheet reports the economic resources it owns and the sources of financing for those resources. The income statement reports its ability to sell goods for more than the cost incurred to produce and sell. The statement of stockholders' equity reports additional contributions from or payment to investors and the amount of income reinvested for future growth. The statement of cash flows reports its ability to generate cash and how it was used. The 4 basic statements can be prepared at any point in time, usually the end of the year, quarter, or month, and can apply to any time span, usually 1 year, 1 quarter, or 1 month. Most companies prepare financial statements for external users at the end of each quarter, known as quarterly reports, and at the end of the year, known as annual reports.
So what I would like to specify here that on one side, at the end of December, we have annual report, but as far as we just prepare accumulated quote reports, what does it mean? For example, let's take the first 3 months, January, February, and March. This is the financial statements for the first quarter. But if we take the second, April, May, and June, in accounting process, we should aggregate information from the 1st of January up to the end of June. And of course, we call this statement as a quarter reports, but on the other side, we aggregate information for 6 months. So this is the accounting procedure. You should understand this. And if you would like specifically the information for these 3 these 3 months, you should take these quarter report at the end of the second quarter and subtract data from the first one. Again, if you take the quarter report from for the third quarter at the end of September, it's also the information for 9 months, from the 1st of January up to the end of September. And at the end of December, this is the, on one side, annual report, but on the other side, we call this report as a report for the fourth quarter. Please don't be confused about it. You should understand the rules in accounting, that's all. And once you know about it, then you can manage the information in financial statements. So now, balance sheet.
The balance sheet reports the financial position, amount of assets, liabilities, and stockholders' equity of an accounting entity at a particular point in time. Let's start by looking at the heading of this financial statement. The heading specifically identifies 4 significant items. It starts with the name of the accounting entity, which precisely identifies the organization for which financial data has been collected. Next, it sets forth the title of the statement, which sometimes varies. For example, a balance sheet may be called a statement of financial position. Then, it specifies the date of or accounting period covered by the statement. A balance sheet is always prepared as of a certain date, such as December 31st. And finally, it sets forth the unit of measure that is used in the statement. For example, the amounts reported may be stated in millions of dollars. The balance sheet has three major captions: assets, liabilities, and stockholders' equity. The basic accounting equation, also called the balance sheet equation, explains their relationship. Assets equal liabilities plus stockholders' equity. A company's economic resources are referred to as its assets. The financing for a company's economic resources comes either from its creditors, referred to as liabilities, or its stockholders, referred to as stockholders' equity. This company's balance sheet reports total assets of $527,400,000, total liabilities of $407,700,000, and total stockholders' equity of $119,700,000. The balance sheet, which has two totals, must always balance. That is, its total assets must equal the total of its liabilities and stockholders' equity. Before we go on, let's take a moment to review the basic accounting equation. We will use it when we begin to account for an organization's business activities. Assets are the economic resources controlled by an entity. Each of these economic resources is expected to provide future benefits to the firm. The exact items listed as assets on a company's balance sheet depend on the nature of its operations. Each is an economic resource needed in its operations. Liabilities indicate the amount of financing provided by creditors. They are the company's debts or obligations. Stockholders' equity indicates the amount of financing provided by owners of the business and reinvested earnings. The investment of cash and other assets in the business by the stockholders is called common stock. The amount of earnings, profits, reinvested in the business and thus not distributed to stockholders in the form of dividends is called retained earnings.
Good. Income statement.
Let's take a look at an income statement to learn about its purpose and content. Again, the heading indicates the name of the entity, the title of the report, and the unit of measure. However, unlike the balance sheet, which reports a company's assets, liabilities, and its stockholders' equity as of a certain date, the income statement reports for a specified period of time, 1 year in this case, which is called an accounting period. The income statement has three major captions: revenues, expenses, and net income, which represents the excess of revenues over expenses. The income statement equation that describes the relationship among these captions is revenues minus expenses equals net income. Companies earn revenues from the sale of goods or services to customers. Revenues normally are amounts expected to be received for goods or services that have been delivered to a customer, whether or not the customer has paid for the goods or services. Retail stores often receive cash from consumers at the time of sale. However, when a wholesaler delivers goods to a retail store, the wholesaler usually receives a promise of future payment called an account receivable, which later is collected in cash. That promise of future payment is reported on the balance sheet since it represents an asset, or in other words, an economic resource owned by the company. Whether the company receives cash or a promise of future payment, the business records the sale as revenue for the period. Various terms are used in income statements to describe different sources of revenue. For example, provision of services, sale of goods, rental of property. Expenses represent the goods or services that the company used in order to earn revenues during the period. Expenses reported in one accounting period may actually be paid for in another accounting period. Some expenses require the payment of cash immediately, while others require payment at a later date. A promise to pay in the future is reported on the balance sheet since it represents a liability, or in other words, a debt owed by the company. Regardless of when the company pays the cash, if the business has used resources to generate revenues, the business records the expense for the period. Various terms are used in income statements to describe different types of expenses: cost of goods sold, selling, general and administrative expense, interest expense, and income tax expense. Net income is the name of the total that is reported on the income statement. In fact, it is often referred to as the bottom line. Net income is the excess of total revenues over total expenses. If the company's revenues are less than its expenses, we'd say the company has a net loss. Recall that the revenues reported might not equal the cash collected from customers, and that the expenses reported might not equal the cash payments made to vendors and suppliers. In fact, net income rarely equals the amount of cash that the company generated from its operating activities.
Okay, very important moment about the explanation of net income. Net income rarely equals cash generated from operating activities. So in the next topic, we will in the next topics we will discuss once again what does it mean and how to treat net income in the income statement. Statement of stockholders' equity.
The statement of stockholders' equity covers the same period of time that was covered by the income statement. The statement of stockholders' equity reports the changes in each of the company's stockholders' equity accounts during that period. Recall from our discussion of the balance sheet that stockholders' equity is comprised of common stock and retained earnings. This company had no changes in common stock during the period. Had it issued or repurchased common stock during the year, those transactions would be reported here. Recall, too, that retained earnings represents the amount of earnings or profits that were invested in the business, and thus not distributed to stockholders in the form of dividends. The amount of net income that was earned during the accounting period increases the balance of retained earnings. Declaring dividends to the stockholders decreases retained earnings.
And the last one, cash flow statement.
The statement of cash flows also covers the same period of time that was covered by the income statement. The statement explains why the company's cash balance changed during the accounting period. The change in cash is broken down into three primary categories of cash flows. Operating activities include cash flows directly related to earning income. Investing activities include cash flows from the purchase and sale of plant, equipment, and investments. And financing activities include cash flows from investors and creditors. The sum of these three categories is added to the beginning cash balance to arrive at the ending cash balance, which must equal the amount of cash reported in the balance sheet prepared as of the end of the accounting period. You may have noted the wording that appeared at the bottom of each of the four basic financial statements. The notes are an integral part of these financial statements. The notes, or footnotes, provide supplemental information about the financial condition of a company. Users of the financial statements must also read this narrative information in order to fully understand the information presented.
Good. Okay, right now I would like to continue with the second topic. This is the current material for today. So first of all, let me open the presentation. So the title of topic 2, investing and financing decisions and the accounting system. And first of all, let's discuss our learning objective. So what we should be able to do after this topic. First of all, we should understand the objective of financial reporting and key accounting assumptions and principle. So this is a really important moment to understand what assumptions we should consider in preparing financial statements. Then we discuss the common balance sheet account titles used in business. So this is more technical moment in accounting. And what is important, what is the key objective in topic 2, apply transaction analysis. I will try to explain you what does it mean transaction analysis to simple business transactions. So this is the basic level. In terms of the accounting model, assets equal to liabilities plus stockholders' equity. So this is the main learning objective of our topic today. So to apply transaction analysis and to stay in balance after each transaction, after each treatment of business transaction. Also, we just learned the term trial balance. What does it mean, trial balance, and how to prepare trial balance? And finally, identify investing and financing transactions and demonstrate how they impact cash flows. So, right now, I would like to mix my presentation with the videos, and I will, first of all, I will show you the video, and after that, provide comments. I think maybe it will be easier for you to understand the material. First of all, let me just return to the list of our videos. So first of all, objective of financial reporting, and then I will provide my comments as well.
Why do companies report financial information in the form of financial statements? The primary objective of financial reporting to external users is to provide financial information about the reporting entity that is useful to existing investors, lenders, and other creditors in making decisions about providing resources to the entity. There is an expectation that each of the users of the accounting information has a reasonable understanding of accounting concepts and procedures. This is one of the benefits of taking this accounting course. You will become a better decision maker when presented with financial information in the future. What do we mean when we say that information should be useful? For accounting information to be useful, it must be relevant and be a faithful representation. Relevant information can influence a decision. It is timely and has predictive and/or feedback value. If you have performed poorly on the weekly quizzes in your Spanish class, you know that you will need to put in more time preparing for the midterm exam in that class. On the other hand, grades on your term paper in last semester's English class are not relevant to the decision you make to set aside time to study for your Spanish midterm. Faithful representation requires information to be complete, neutral, and free from error. For example, when you receive your grade in your biology class, it should encompass all of the work that you completed. The sum of your individual scores should be mathematically correct, and it should not be influenced by the fact that your biology teacher liked or didn't like you. Other qualitative characteristics that enhance the usefulness of information that is relevant and faithfully represented include comparability, verifiability, timeliness, and understandability.
So, dear students, this is the first learning objective about the basic principles of preparing financial statements. And first of all, once again, the main goal of financial statement to be useful for decision makers. And of course, it's a reasonable question. Who are these decision makers? First of all, we discuss those partners who would like to finance the business, lenders, creditors, and potential investors. In order to get financing, we should explain, we should disclose information about our company in order to make our business more transparent and to provide potential information users with the forecasts concerning the future. It's also very important. And the main principles are the following. Information should be relevant, faithful, comparable, in time, and understandable. So, and verifiable. So this is all principles about the main requirements. And to be relevant and to be faithful, this is the key principles on this list. You see them on the first place, and information should be neutral, free of error, without any intention to manage to the wrong decisions. So this is all about main requirements to useful financial information. This is the continuation of the basic principles, and these principles about recognition and measurement concepts.
Before we look at the definitions of the various items that appear on the balance sheet, we should learn about the three assumptions and the measurement concepts that underlie those definitions. The separate entity assumption states that each business's activities must be accounted for separately from the activities of its owners, all other persons, and other entities. This means, for example, that when an owner purchases property for personal use, the property is not an asset of the business. The going concern assumption states that unless there is evidence to the contrary, we assume that the business will continue operating into the foreseeable future, long enough to meet its contractual commitments and plans. Under the monetary unit assumption, each business entity accounts for and reports its financial results primarily in terms of the national monetary unit, for example, dollars in the United States, without any adjustment for changes in purchasing power, for example, inflation. Finally, accountants measure the elements of the balance sheet using what is called a mixed attribute measurement model. Most balance sheet elements are recorded at their cost, or historical cost, which is the cash equivalent value on the date of the transaction. For example, assets are initially recorded on the exchange date at the cash paid, plus the dollar value of all non-cash considerations, such as the trade-in value of a used asset.
So, dear students, in this short video, we observed very important assumptions, and the first, the one is separate entity. So it means that we cannot mix private property, private resources and assets of the business. Why we call resources as assets? This is resources which provide business with the potential ability to generate profit. In our private life, we are not looking to the profit or other earnings. We just simply spend our cash and other resources for our private life. Next one, this is the basic principle about going concern. So we should understand that every business can be attacked by any external or maybe internal events. And when we prepare for financial statements, we assume that in the near future, this business will continue the activities. Of course, it's a reasonable question. What do we mean by the near future? Near future, this is the period during this period companies should be able to meet all obligations and commitments. Unit of measure, everything in accounting should be measured in national currency or other functional currency. And also mixed attributed measurement model. It means that we should identify two types of cost. Initial cost in the moment of purchase or construction, we should calculate this cost. And then the cost in the current period, when we should evaluate the all external and internal factors in order to understand, do we find our cost of assets appropriate to the current moment, or we need some adjustments for the fair value of the assets. This is what we call mixed attribute measurement model. And in our further topics, we identify initial cost and then the current cost in the period. Elements of the balance sheet.
Recall that the purpose of a balance sheet is to report the financial position, amount of assets, liabilities, and stockholders' equity of an accounting entity at a particular point in time. Let's define each of the elements of a company's balance sheet. Assets are probable future economic benefits, owned or controlled by an entity as a result of past transactions or events. To decide if something is an asset, ask yourself two questions. First, does the company own or have a legal right to it? Second, if so, does it have a benefit that will last beyond the next few weeks? For example, you may have purchased gas for your car on the way to class this morning. Technically, that gas is an asset. However, if we treat it as an asset, we will need to keep track of its use, which will be much too cumbersome. As a result, instead, we would treat it as an expense. On the other hand, the gas station has large underground tanks of gas. The gas station would treat that gas as an asset and keep track of how much is on hand. Take a moment to think about the other assets that you have. They might include your car, your clothing, your backpack, the cash in your checking account, your laptop, and your textbooks. Most companies list assets in order of liquidity, which means how soon an asset is expected to be turned into cash or used. Current assets are those resources that will be used or turned into cash within 1 year of the balance sheet date. As a company that operates a restaurant, this company's current assets include cash, short term investments in the stocks or bonds of other companies, accounts receivable due from customers and others, supplies to make and serve the food, and prepaid expenses for rent, insurance, and advertising paid in advance of use. Some companies report other current assets to summarize any other smaller asset accounts. All other assets are considered long term or non current. This company's long term assets include land, buildings, equipment, long term investments in the stocks and bonds of other companies, and intangibles, non physical assets such as trademarks and patents. Liabilities are defined as probable future sacrifices of economic benefits arising from present obligations of a business as a result of past transactions or events. Entities that a company owes money to are called creditors. Take a moment to think about your liabilities. They might include a car loan, a short term loan from your brother, and the balance on your credit card. Liabilities are usually listed in order of maturity, that is, how soon an obligation is to be paid. Liabilities that a company will need to pay or settle within the coming year with cash, goods, other current assets or services are classified as current liabilities. This company's balance sheet includes the following current liabilities: accounts payable to suppliers, unearned revenue for unredeemed gift cards that have been purchased by customers, and accrued expenses payable for wages, utilities, taxes, and interest on debt. Long-term liabilities might include notes payable, due after 1 year. Identifying current assets and current liabilities allows external users of the financial statements to assess the amounts and timing of future cash flows. Stockholders' equity, shareholders or owners' equity, is the residual interest in the assets of the entity after subtracting liabilities. It is a combination of the financing provided by the owners and by business operations. Financing provided by owners is referred to as contributed capital. Financing provided by operations is referred to as earned capital or retained earnings. When companies earn profits, they can be distributed to owners as dividends or reinvested in the business. The portion of profits reinvested in the business, that is, not paid out in dividends, is called retained earnings.
So, dear students, sorry, very comprehensive video, only 4 minutes, but a lot of information. Let me repeat once again. First of all, balance sheet. We already introduced with this document, but in order to prepare the balance sheet, we should classify all assets and all liabilities into two main categories: current assets, non-current assets, current liabilities, non-current liabilities. And of course, it's a reasonable question, what is the criteria for such classification? For assets, we use the criteria of liquidity. So it means that the ability to be converted into cash. So all current assets, this is the assets which should be converted into cash during 1 year or operating cycle. And as for the liabilities, we should apply the criteria of maturity date. So how soon we should meet our obligations, This is why when we prepare balance sheet, first of all, we should follow these rules. So we should disclose items into the right order. For example, on the top, we can put current liabilities, then non-current liabilities, or we can start with the non-current assets and then continue with the current assets. It's not the specific rule how to organize. This is the decision of every company to choose these two possible alternatives, or one of these possible alternatives: increase in liquidity approach or decrease in liquidity approach. This is about the assets, and as for liabilities as well, we can use the approach of increasing maturity maturity or decreasing. For example, here we have on the top current liabilities, and just on the bottom non-current liabilities. But it could be another approach. We start with the non-current liabilities, then current liabilities. But in such circumstances, we should put stockholders' equity on the top of this second section of the main accounting equation. As for stockholders' equity, on the first place, we always put contributed capital, and the second place, this is the earned capital or retained earnings. So this is the main composition of the balance sheet. And in our next exercises in the next topics, we should apply these structure. So first of all, to classify assets into current, non-current, and then to put them on the balance sheet in the right order. Business transactions. Now we start understanding accounting language, and what is important to understand the concept of business transactions in terms of accounting, in order to translate from from general financial language into accounting language. Let's discuss first of all what classifications we should apply for business transactions.
Events that are recorded as part of the accounting process are called transactions. Transactions include two types of events: external and internal. The first step in translating the results of business events into financial statement numbers is determining which events to include. Most transactions involve external events, which are exchanges of assets, goods, or services by one party for assets, services, or promises to pay, that is, liabilities, from one or more other parties. Something is received and something is given in return. For example, you may have purchased your textbook using cash. You received a textbook in exchange for cash. You may have purchased a laptop using a credit card. You received the laptop in exchange for your promise to pay. Or a neighbor who will be out of town for the summer may have paid you in advance for cutting his lawn. You received cash in exchange for your promise to provide services. We will be focusing on transactions involving external events. Internal events include certain events that are not exchanges between the business and other parties, but nevertheless have a direct and measurable effect on the entity. For example, a taxi company may have paid its annual premium relating to its auto insurance last September. A portion of that premium is used up each month. We will address how to record transactions involving internal events in the next chapter. Let's assume the management of a WNBA team just signed a contract with a new player who will receive $1 million during each of the next 3 years. Should the signing of the contract be reflected in the financial statements? To answer this question, think about whether an exchange has taken place. In most cases, signing a contract is not considered to be an accounting transaction because it involves only the exchange of promises, not of assets such as cash, goods, services, or property. Each party to the contract has exchanged promises. That is, the player promises to play basketball, and the management of the team promises to pay the player over the course of each season. However, as each of the next 3 seasons progress, the exchange of services for pay results in a transaction that the team must record. Because of their importance, long-term employment contracts, leases, and other commitments may need to be disclosed in notes to the financial statements.
So, dear students, again, a small portion of new knowledge, of new information. First of all, we should classify from accounting point of view all transactions into external and internal. Of course, I hope you understood how to treat external events. It's events between the entity and the partners of the business. And this is the one part of accounting process. And the second part, how to treat internal events. And sometimes this is the most complicated moment in accounting process in order to treat properly and accurate the internal events. So we will talk about internal events in more detail in the topic 3 and 4. And right now, I would like to say that the reason to treat internal events in order to adjust revenues and expenses for the same accounting period and to match revenues and expenses between each other. And the second important moment in this video about signing a contract. You know that in management process, signing a contract, this is a very outstanding event in the management achievements. But what is important that signing contracts, it's not a subject for accounting process, because accounting process registers only real facts of assets or liabilities in the owner's equity changes. A contract is only a promise to do something in the future. So this is why we should remember about it. Signing a contract is not a subject for accounting treatment. But in order to provide potential information users about possible future outflows, companies should disclose information about long-term employment contracts, leases, agreements, and other commitments, including contingencies in the notes to financial statements. Accounts. This is the heart of accounting language. Attention, please, to understand what does it mean.
Companies keep track of individual asset, liability, stockholders' equity, revenue, and expense items using a standardized format called an account. An account accumulates the dollar effect of transactions of a given financial statement item. Knowing the amount of total assets owned by a company is important, but management must keep track of individual assets. For example, most companies set up separate accounts for cash to make sure enough is on hand to pay bills, accounts receivable to keep track of what is owed by customers, and supplies to know when to reorder. As the company grows and acquires additional assets, additional accounts are set up for those assets. To facilitate the recording of transactions, each company establishes a chart of accounts, a list of all account titles and their unique numbers. The accounts are usually organized by financial statement element, with asset accounts listed first, followed by liability, stockholders' equity, revenue, and expense accounts, in that order. The balances of the accounts are then used to prepare the financial statements. The accounts you see in the financial statements of most large corporations are actually summations or aggregations of a number of specific accounts in their record-keeping system. For example, a company that operates restaurants would maintain separate accounts for food, beverage, and packaging supplies, but would combine them under supplies on its balance sheet.
So what is important to understand that in order to collect information about specific item, we should open an account. In order to understand what does it mean an account, I can compare an account with a file. If you would like to collect information about any portion of knowledge or some other information, you can create the file and collect information. The same as a file. We all have files on our computers, the same system in the accounting process. We open accounts, we collect and summarize and register information about the specific item. In order to create this system of individual accounts, we should create such document as a chart of accounts. What does it mean, chart of accounts? This is the list of all accounts with unique numbers and titles. In order to organize the chart of accounts, we can classify all items into 5 components: assets, liabilities, stockholders' equity, revenues accounts, and expense accounts. And what is important that we collect on accounts a very detailed information, but before we prepare a balance sheet, we should aggregate some accounts in order to disclose information in the balance sheet in this aggregated format. For example, let's take this a small example about a restaurant. So this company has food account, beverage account, packaging account, and maybe some other else accounts. But in order to prepare a balance sheet, we should sum up all ending balances of every account and to put on the balance sheet only one aggregated amount of supplies without any further details. This is why we need supplementary notes in order to disclose information about some details, but not directly in the financial statement. So once again, all financial statements are aggregated information about financial position and results of the company. Accounts. Transaction analysis. This is the key learning objective of our topic today. So let's see how to analyze transactions and how to make records.
Transaction analysis is the process of studying a transaction to determine its economic effect on the entity in terms of the accounting equation. Recall that most transactions involve external events in which the business exchanges assets or services for assets, services, or promises to pay with one or more external parties to the business. In other words, each transaction involves an exchange. Something is received and something is given. As a result, every transaction has an effect on at least 2 accounts, one or more accounts relating to what is received and one or more accounts relating to what is given in exchange. This is known as the dual effects concept. The accounting equation must always remain in balance when we record a transaction. These 2 rules form the basis of the 2-step approach that can be used when analyzing transactions. First, consider what was received and what was given. After identifying the accounts affected, classify each type of account and decide if the transaction causes each account to increase or decrease. Second, be sure that the accounting equation is in balance.
So dear students, now on the screen you can see the procedure of transaction analysis. First of all, I would like to repeat once again, this is the main dual concept of accounting. What does it mean? For every transaction, we must identify at least 2 accounts involved, at least 2. It could be more. So, but at least 2 accounts should be identified in order to determine these relationships, what was received, what was given. So this is the first question: what was received and what was given. And on this step, we should identify first of all each account affected by title. For example, cash, supplies, accounts payable, and other. So, and please remember that at least 2 accounts change, at least 2. And then we should classify each account by type. For example, if cash, it's an asset account. Accounts payable, it's a liability account. And so this is important to classify or to identify the basic element of each account. And finally, on this step, we should determine the direction of the effect. There are 2 possibilities: plus or minus, increase or decrease. The account increased or decreased. So this is the main and this is the important step in transaction analysis. And finally, we should verify, is the accounting equation in balance after the treatment? What does it mean in balance? Assets are equal to liabilities and stockholders' equity. Now we just see some transaction analysis illustrated, and we in this video we should understand how to apply transaction analysis for the particular business transactions and how to treat in a real life in real process.
To illustrate the transaction analysis process, let's assume that Janine decides to incorporate and operate a consulting business. The business issues 10,000 shares of common stock with a par value of $1 per share in exchange for $15,000 cash and land worth $25,000. So the shares are issued at a market value of $4 per share, which is computed by dividing the sum of the amounts received, $40,000, or the cash of $15,000 plus the land valued at $25,000 by the 10,000 shares issued. Step 1. The business receives cash and land and gives shares of common stock in return. Cash, an asset account, increases by $15,000. Land, another asset account, increases by $25,000. When a corporation issues common stock, the amount received, which totals $40,000, or cash of $15,000 plus land of $25,000 in this transaction, affects two separate stockholders' equity accounts. The common stock account increases by $10,000, which is the product of the 10,000 shares issued times the $1 par value per share. The additional paid-in capital or contributed capital in excess of par account increases by $30,000, which is the product of the 10,000 shares issued times the $3 excess over par value per share. Step 2. The recording of this transaction keeps the accounting equation in balance. Total assets equal $40,000 and total liabilities and stockholders' equity also equal $40,000.
Okay, so dear students, this is the case how to treat. First of all, to follow the rules to identify what was received, what was given, received, given, to identify the specific accounts, and then the basic elements, and then the direction of effect, plus. So after that, we should verify that we stay in balance. So we see that we have increase in assets, increase in liabilities in stockholders' equity. So the accounting equation is in balance after the transaction. So, dear students, I would like to say that in your presentation, which is already available in Smart LMS, you can find several transactions with the explanation how to apply transaction analysis and how to treat. So let me maybe switch for a moment to the presentation to show you where you can find. Just a moment. So, dear students, this is our current presentation, and let me scroll down just to show you that, for example, 15, 16, 17, 18, 19, you see this is 20, so we have six slides about transaction, analyzing transaction. The first one, of course, about issuance of shares, then transaction analysis, then all other activities, and also you can find these transactions and the description of this transaction in the textbook. This is what I told you, that all materials are connected, are in direct relationships. So the presentations are always in connection with the content of the textbook and with the video. So you can read and understand how to apply transaction analysis. So right now, let me return back and continue, because today we have other important learning objective: to learn the language, to learn about debits and credits. So now, general journal and ledger. Of course, we understand that nowadays we have, well, once again, We understand that nowadays we should keep our records in accounting, special accounting software. But even if it's a special software, we always organize information in special journals and general ledger. And you should understand what is the content of these main accounting documents and how to manage information presented in these documents.
If we are recording just a few transactions for a very small and simple business, the columnar worksheet approach might make sense. However, most organizations are much more complicated. There might be a need to keep track of numerous daily transactions affecting quite a few asset, liability, and stockholders' equity accounts. Although businesses still use the two-step transaction analysis process to record transactions during and at the end of the accounting period, companies typically use a computerized accounting system to perform the primary activities of the accounting cycle. You are already familiar with the analysis of transactions. We will use that knowledge as we learn how large complex companies record and post transactions. After a transaction has been analyzed, it is recorded with a journal entry in the General Journal. For now, think of the General Journal as a diary. It is a chronological listing of all the company's transactions. Before accounting systems were computerized, the pages of the General Journal were bound in a book, which is part of the reason we say books when we refer to a company's accounting records. However, its usefulness was limited. If the owner of a business needed to know how much cash was in the company's checking account, the accountant would need to comb through the list of transactions, which could number in the thousands or maybe even in millions, find those affecting the cash account, and sum those transactions. To provide this information, companies also use a general ledger. The general ledger has a page for each account that shows the effects of the company's transactions on that account. It also provides a balance for each account. This is the second of the company's books. The process of transferring the effects of accounting transactions from the general journal to the general ledger is referred to as posting. After the journal entries have been recorded, the dollar amounts are posted or transferred to each account affected by the transaction to determine the new account balances. To help you remember, think of what happens in a post office. After the letters are collected from mailboxes throughout the city, they are sorted by zip code and then by address so that they can be delivered. The posting process does the same thing. The effects of transactions are sorted by accounts so that account balances can be determined. It is a bit cumbersome to use an entire general ledger page to summarize the effects of transactions and determine the balances for individual accounts. To make this process easier, we will instead use a T account, which is a simplified representation of a ledger account.
So, dear students, this is a little bit more technical video, but really important for you to be able to understand accounting documents and to read without any interpreter or translator. So first of all, we should collect information in specific journals, and there we can find all all descriptions of the transactions, but in accounting language. In accounting language, what we mean, language debit and credit. So our next sorry, our next video about debits and credits.
Our original approach to transaction analysis, illustrated here by just showing a cash column, included using increases, represented by plus signs, and decreases, represented by minus signs, to show how a transaction affected an account. Let's take a look at how accountants actually record increases and decreases in the company's books. Luca Pacioli, a mathematician and accountant, published a textbook, Summa de Arithmetica, which describes the system of double-entry bookkeeping that we still use today. And since he spoke Latin, he used the Latin word deberere, meaning to owe, to refer to the left side where the payments owed to the business were recorded. This was abbreviated as DR and was translated into the word debit. The Latin word credere, meaning belief or trust, was used to refer to the right side where the payments owed by the business on good faith were recorded. This was abbreviated as CR and was translated into the word credit. Let's go back to our original approach to recording transactions. We recorded all increases and decreases to an account in a single column. Let's split the cash account column into two. The left column is the debit column and the right column is the credit column. Remember what Luca Pacioli decided. For assets, such as cash or accounts receivable, increases are recorded with debits and decreases are recorded with credits. Liabilities and stockholders' equity are on the opposite side of the accounting equation. So to keep things in balance, the rules for debits and credits are the opposite. For liabilities, such as accounts payable, increases are recorded with credits and decreases are recorded with debits. Stockholders' equity accounts follow the same rules as liabilities. Increases to the common stock and additional paid-in capital T accounts, when owners made investments, are recorded with credits. The increase to the retained earnings account, when net income is reflected, is also recorded with a credit. A decrease to the retained earnings account, when dividends are declared, is recorded with a debit. Take the time now to study this summary of the basic transaction analysis model, which is also set forth in your textbook, and refer to it often while you are recording transactions.
So dear students, very important slide to understand the accounting language. First of all, a few comments about the structure of every account. Account is a table which consists of two columns, debit column and credit column. Debit column always on the left, credit column on the always on the right. But based on the main accounting equation, we should register or make records about the effect plus or minus two possible effects. This is why we have only two columns. Must be different. For assets, we should make records for all increases on debit side and all decreases on credit side. As for liabilities and stockholders' equity, this is the opposite approach in order to stay in balance. When we transfer to the one side of the equation into another, we should change the sign. This is why for liabilities and stockholders' equity, we have minus on debit, and plus on credit, or increase on credit. This formula provides us with the combination of assets, liabilities, and stockholders' equity, and this is the reason why we always stay in balance after each transaction.
Now, let's use debits and credits to record transactions in the General Journal. When we record a transaction in the General Journal, we refer to it as a journal entry. When we record a journal entry, we need to make sure that the debits in that entry equal the credits in that entry. Let's assume that the company issued 10,000 additional shares of common stock with a par value of 1 cent per share. The market value of the shares was 37 cents per share, and the company received $3,700 in cash from investors. Cash increases by $3,700. Common stock increases by $100, computed as 10,000 shares times 1 cent par value per share, and additional paid-in capital increases by $3,600, computed as 10,000 shares times the 36 cents excess over par value per share. The journal entry includes a debit to cash to increase that asset account for $3,700, a credit to common stock to increase that stockholders' equity account for $100, and a credit to additional paid-in capital to increase that stockholders' equity account for $3,600. Note that this entry is called a compound entry because it affects more than two accounts. Typically, an additional line is included with a brief explanation of the entry. Now, let's take a look at how we would post that entry to the related general ledger accounts. When we post an entry from the General Journal to the General Ledger, we do the following. Enter the date of the entry in each of the affected General Ledger accounts. Enter the debit amounts in the journal entry in the debit columns of the related accounts in the General Ledger. Enter the credit amounts in the journal entry in the credit columns of the related accounts in the General Ledger. Determine the account balances in the General Ledger. Next, we will take a look at how to determine account balances. Recall that a T account is a simplified version of an account page in the general ledger. You won't find T accounts in a company's books. They're an analytical tool that we will use to determine account balances. The layout of a T account includes the account title, a left or debit side, and a right or credit side. The difference between the dollar amounts on the two sides represents the account balance. If the sum of the amounts in the debit column is greater than the sum of the amounts in the credit column, the account has a debit balance, which is the case here. On the other hand, if the sum of the amounts in the credit column is greater than the sum of the amounts in the debit column, the account would have a credit balance.
So, dear students, I would like to mention here that on one side, of course, if a sum of amounts on credit is more than on debit, we put a credit balance or ending balance, but we should understand that we cannot put, for example, cash on credit side because cash is always positive. And if it happens that the credit amounts exceed the debit amounts, then we should identify any kind of error in the recording process. So this is very important to understand. Of course, every account has beginning balance, ending balance on one side, debit or credit side, but we should understand that always debit or credit balance should be on the positive side. For example, for assets accounts, it always debit amounts, and for the liability in stockholders equity accounts, we have a plus on credit side. This is why we determine ending balance on the credit side of the account, of the credit side of account. And finally, we have trial balance for today.
Before financial statements are prepared at the end of the accounting period, most companies will prepare a trial balance. After the journal entries are posted to the general ledger T accounts, the sum of the accounts with debit balances should equal the sum of the accounts with credit balances. We can check to make sure that this is the case if we prepare a trial balance. A trial balance lists the names of the T accounts in financial statement order: assets, liabilities, and stockholders' equity. Revenues and expenses are usually listed at the end. The ending account balances appear in the next two columns. Debit balances are indicated in the left column and credit balances are indicated in the right column. Then the two columns are totaled to provide a check on the equality of the debits and credits.
So, dear students, this is all what you should know about trial balance. Trial balance, this is the list of all accounts with the debit and credit ending balances. And the main characteristic, the total debits must be equal to total credits, So, dear students, our lecture is over for today. Let me open for a second presentation, and I would like to finish with this final comment about the presentation. In this presentation, as I told you, find the description of all transactions, and look here in each slide you can find short comments which help you to understand the content. And then about basic transaction analysis model with all comments, the structure of accounting entity, the transaction analysis illustrated for preparing debits, the accounting entries with debits and credit. You find these analysis. And then transaction analysis illustrated in the T format. All this material is based on the textbook, and finally trial balance. This is the ending, so the ending balance sheet. So all the material is available, and I would like to say that the file with exercises for topic 2 is also available, so you can start your preparations for the next week for seminars. This is for those students who already attended seminars yesterday. For those who will have the seminars on Friday, we have our first topic. Please be ready for the first topic, not for the second one. Thank you very much for your attention. Our lecture is over. Right now, I will stop recording, and you can find this lecture in the tips for your self preparation if you find it useful. Do you have any questions?